Why free checking isn't actually free, the hidden economics of bank accounts. For decades, banks have advertised the same promise: free checking. No monthly fees, no maintenance costs, no strings attached. It sounds simple, almost generous. But free checking is not a gift, it's a design choice. Banks don't offer free checking because it costs them nothing. They offer it because it earns them something, just not in the way most people expect. Today, we're breaking down how free checking actually works, where the money really comes from, and why accounts that appear to cost nothing are among the most carefully engineered products in modern banking. For most of modern banking history, checking accounts were not free. They were explicitly priced. Monthly maintenance fees were normal. Transaction limits were standard. Banks charged customers directly for access. This wasn't greed, it was structure. Mid-20th century banks operated in a tightly regulated environment. Interest rates were capped. Geographic expansion was restricted. Competition was limited. Banks made money primarily from predictable interest spreads, and checking accounts were treated as a cost center. Charging customers directly made sense. Free checking did not exist because it couldn't. It didn't exist because it didn't need to. That began to change in the late 1970s and 1980s. Financial deregulation removed caps on interest rates, loosened geographic restrictions, and increased competition among banks. At the same time, inflation and volatile rates made deposit funding far more valuable. Banks needed scale, they needed stable funding, they needed customers who would stay. Technology accelerated this shift. Electronic payments replaced paper checks. Debit cards replaced cash. Digital settlement reduced the cost of transactions to near zero. Once processing became cheap, volume mattered more than pricing. This is where free checking emerged. Lower the barrier to entry. Increase account adoption. Monetize activity elsewhere. When banks say free, they are not using the word casually. They are using it strategically. In banking, free does not mean unprofitable. It means indirect. Free checking accounts are not revenue products on their own. They are infrastructure. They exist to anchor behavior, capture data, and stabilize cash flows. To understand why, you have to look at what a checking account actually provides to a bank. At a basic level, a checking account creates three things. First, it creates deposit funding. Money sitting in a checking account is cheap capital. It usually pays little or no interest, yet it can be used to fund loans, investments, and liquidity requirements. Second, it creates transaction flow. Checking accounts are where salaries arrive, bills are paid, subscriptions run, and everyday spending happens. This activity gives banks visibility into behavior. Third, it creates stickiness. Once an account is linked to payroll, utilities, subscriptions, and payment cards, it becomes difficult to leave. Free checking is not about generosity, it's about lock-in. Banks know something most customers don't think about. The moment you close a checking account, you don't just move money, you disrupt systems. Direct deposits must be updated, automatic payments can fail, cards must be replaced, apps must be learned again. This friction is not accidental. Free checking lowers the barrier to entry, while complexity raises the barrier to exit. That asymmetry is extremely valuable. If checking accounts are free, where does the money come from? From cross-subsidization. Free checking accounts generate revenue indirectly through multiple channels. One of the largest is interchange fees. Every time you use a debit card, the merchant pays a small fee to the payment network. A portion goes to the bank. Individually, these fees are small. At scale, they are enormous. As cash usage declined, interchange became one of the most reliable income streams. Banks don't need you to overdraft. They don't need you to pay interest. They need you to transact. Another source is float. Float is the time between when money leaves one account and settles into another. During this window, the bank temporarily holds funds. Individually, this delay feels insignificant. System-wide, it creates billions in usable liquidity. This is one reason why transfers are not always instant. Speed reduces float. Float reduces funding costs. Regulators tolerate this delay because it improves system stability. Then there are fees, but not in the obvious way. Free checking does not eliminate fees, it redistributes them. Overdraft fees, out-of-network ATM fees, foreign transaction fees, wire fees, expedited payment fees. As certain fees became regulated, others expanded. This was not accidental. It was adaptive. Banks don't expect everyone to pay fees. They expect enough people to pay them often enough. Banking models are built on probability, not fairness. Importantly, free checking also acts as a gateway product. Banks do not measure success by the profitability of a checking account alone. They measure it by what follows: savings accounts, credit cards, personal loans, mortgages, investment products. The checking account is the front door. Once a customer enters the system, future products become easier to sell, easier to price, and easier to manage. Free checking increases the size of the funnel. There is also a regulatory dimension. After major financial crises, regulators place greater emphasis on stable retail deposits. A large base of checking deposits improves liquidity ratios, capital planning, and stress test outcomes. From a regulatory perspective, free checking is not just a customer product. It is a stability signal. This explains a critical detail. Banks are willing to lose money on some checking accounts. Not all customers are profitable. That's fine. Banking systems are designed around portfolio economics, not individual outcomes. As long as aggregate behavior remains predictable, the system works. There is also a behavioral layer. Free creates a psychological anchor. When an account is labeled free, customers are less likely to scrutinize it. They are less sensitive to small losses. Free reduces vigilance. This is why banks advertise the absence of a monthly fee more loudly than the presence of other costs. The label shapes perception. Free checking also normalizes data extraction. Every transaction reveals information: spending habits, income stability, risk patterns, life changes. This data feeds internal models for credit decisions, pricing, fraud detection, and product design. This is not surveillance in a cinematic sense. It is optimization. None of this requires malicious intent. Banks are not deceiving customers in a simplistic way. They are optimizing within a competitive, regulated system. Free checking survives because it works. It attracts customers. It stabilizes deposits. It generates indirect revenue. It reduces churn. Calling it free is not a lie. It's a framing choice. The real cost of free checking is not money. It is attention. Free checking encourages you not to think about your account as a product. It encourages you to treat it as a neutral utility, and utilities are rarely questioned. This is why free checking persists even as branches close, service is automated, and human interaction disappears. The account itself is no longer the product. Your behavior is. Free checking is not free because it doesn't need to be. It is subsidized by scale, data, timing, and probability. It works because most people use it passively. It works because friction is asymmetric. It works because costs are unevenly distributed. This is not a warning. And it is not advice. It is a description of how the system functions. Once you see free checking as infrastructure instead of generosity, its design choices make sense. In the next episode, we'll look at why banks delay transfers and how timing, not technology, explains most of what feels broken. This is not financial advice. This is system literacy. What matters in complex systems is not intent. It's incentives. Most outcomes don't come from bad decisions. They come from structures designed to work quietly, repeatedly, and at scale. Once you see the system, you stop reacting to individual moments and start understanding why those moments exist at all. That perspective doesn't tell you what to do, it simply explains what's happening. Slow. If you want to keep understanding how everyday systems really work, subscribe. New episodes break down one system at a time. This isn't about outrage, firm, it's about clarity. See you next time.